If you held silver yesterday, you just lost 31% of your capital in 7 trading hours, not over weeks, not through gradual decline. In a single session on January 31st, 2026, silver collapsed from $30.42 per ounce at the New York Open to $20.98 at the close, the largest single-day percentage decline since the Hunt brothers silver manipulation unraveled in March 1980, 46 years ago. This was not a flash crash corrected within minutes. This was sustained, accelerating liquidation across physical markets, futures exchanges, and exchange-traded products simultaneously. By 4 p.m. Eastern, $127 billion in notional silver exposure had been erased from global markets. Retail investors who purchased coins and bars over the past 18 months saw their positions decline by amounts that, in many cases, exceeded their annual incomes. Institutional holders of silver ETFs watched 9-figure losses accumulate in real time. The move has already occurred. The wealth has already been destroyed. The forced liquidations have already executed. The margin calls have already been issued. What remains is understanding the mechanics of what just happened and what it reveals about the structure beneath commodity markets when narratives collapse. I'm John A.G., and this is the Collapse Files. At 9:30 a.m. Eastern on January 31st, 2026, COMEX silver futures opened at $30.42 per ounce, marginally higher than the prior session's close of $30.28. Within the first 15 minutes of trading, volume exceeded 42,000 contracts, elevated but not extraordinary for the session open. Prices drifted lower to $30.18 by 10:00 a.m., consistent with normal intraday volatility. At 10:14 a.m., a coordinated wave of selling began simultaneously across COMEX futures, London over-the-counter spot markets, and Asian electronic trading platforms. Within 8 minutes, silver declined from $30.18 to $28.34. A 6.1% drop that triggered the first round of automated stop-loss orders from algorithmic trading systems. These stops, designed to limit losses by selling when prices breach predetermined thresholds, generated an additional 28,000 contracts of selling pressure between 10:22 a.m. and 10:35 a.m. By 11:09 a.m., silver had reached 26.47, down 13% from the open. At this level, margin calls began triggering across retail brokerage accounts. Investors who had purchased silver futures using 16.1 leverage, the standard initial margin requirement, allows control of $152 to $100 worth of silver per contract with just $9,250 in posted collateral, saw their accounts fall below maintenance margin thresholds. Brokerage systems automatically liquidated these positions without discretion or delay, adding 34,000 contracts of forced selling between 11:00 a.m. and 11:45 a.m. The selling pressure overwhelmed available bids. Market makers, who typically provide liquidity by standing ready to purchase when others are selling, withdrew from the market as volatility exceeded their risk parameters. Bid-ask spreads, normally 2 to 3 cents per ounce, widened to 47 cents by 11:30 a.m., indicating severe liquidity stress. Participants wanting to exit positions faced the choice of accepting catastrophic execution prices or holding through further declines. By 1 p.m., silver had declined to $23.18, a 23.8% intraday loss. The CME Group, which operates COMEX, considered imposing trading halts under circuit breaker rules, but determined that continuous trading, despite extreme volatility, was preferable to freezing markets and creating additional uncertainty. The decision allowed liquidation to continue uninterrupted. The final capitulation occurred between 2:45 p.m. and 3:30 p.m. A cluster of large institutional sellers, later reported to include hedge funds closing macro commodity positions, mining companies exercising hedges, and at least one sovereign wealth fund reducing precious metals exposure, executed block sales totaling approximately 67,000 contracts. This selling, concentrated in a 45-minute window, drove silver to its intraday low of 20.91 at 3:17 p.m. The metal recovered marginally to close at 20.98, finishing the session down 9.44 or 31.0%. Total COMEX silver volume for the session reached 287,400 contracts, 1.437 billion ounces of notional silver, representing 173% of global annual mine production traded in a single day. For context, average daily volume in January 2026 was 87,000 contracts. The 287,400 contracts represented a 230% increase over normal activity, driven almost entirely by forced liquidation rather than discretionary repositioning. Simultaneously, the iShares Silver Trust, SLV, the largest silver-backed ETF, experienced redemptions of 47 million ounces, an 8.2% decline in assets under management in one day, requiring the trust to sell physical silver into a collapsing market to meet redemption requests. while smaller silver ETFs saw similar outflows. Combined ETF liquidation totaled approximately 73 million ounces, valued at $187 billion at average execution prices. What makes this abnormal is not merely the percentage decline — commodities can be volatile — but the concentration of the move into a single session with no corresponding fundamental catalyst. There was no geopolitical shock, no central bank announcement, no industrial demand collapse, no mining supplies surge. The move was purely technical. Leveraged positioning meeting coordinated selling pressure in an illiquid market, creating a reflexive cascade where forced selling begat lower prices, which triggered more forced selling, which begat even lower prices, until all leveraged participants had been liquidated and the selling exhausted. The silver market operates through layered leverage across multiple participant classes. At the foundation are physical holders, investors who purchase bars and coins for delivery and storage. These participants have no leverage and cannot be forced to sell regardless of price declines. They represent stable, price-insensitive demand that absorbs supply during crashes. Above this foundation are ETF investors who purchase shares representing fractional ownership of pooled physical silver. These investors can be forced to sell if the ETF share price declines below their cost basis and they lack conviction to hold through losses. But they face no margin calls or automatic liquidation. Their selling is discretionary and typically occurs gradually as pain thresholds are reached. The next layer is futures market participants who use moderate leverage, perhaps 4:1 to 8:1, to amplify exposure while maintaining substantial equity cushions. These participants face margin calls if prices move against them, but they typically have capital reserves to meet those calls and avoid forced liquidation. Their selling becomes forced only if declines are severe enough to exhaust all available capital. At the top of the leverage pyramid are maximum leverage speculators using 15:1 to 20:1 leverage to control large notional positions with minimal capital. These participants are extremely fragile. A 6 to 7% adverse price move exhausts their equity cushion and triggers automatic liquidation. They cannot survive normal volatility, let alone crisis volatility. They exist only in stable, trending markets and are instantly purged when volatility spikes. The system functions when market makers provide liquidity across all conditions, absorbing selling pressure during declines by purchasing inventory at discounted prices, then redistributing that inventory when buying interest returns. Market makers profit from bid-ask spreads and inventory turnover, not from directional price bets. Their function is critical. They transform lumpy, one-directional order flow into smooth, continuous price discovery. The system fails when volatility exceeds market maker risk limits. Most market-making firms operate with value-at-risk (VAR) constraints that limit maximum potential daily losses to defined thresholds, often 2 out of 4% of capital. When price swings exceed these limits, automated systems force market makers to reduce inventory to zero and withdraw from providing liquidity. This occurred at approximately 11:15 a.m. on January 31st, when intraday volatility crossed 15%. Once market makers withdraw, there is no mechanism to absorb concentrated selling. The market becomes one-directional: sellers at any price, buyers only at deeply discounted prices, and no intermediaries willing to bridge the gap. Prices fall until reaching levels where physical buyers with long time horizons recognize value and deploy capital. On January 31st, that level appears to have been approximately $21 per ounce, near the all-in sustaining cost for many primary silver producers. The trapped participants were those using maximum leverage with no capital reserves to meet margin calls. A retail investor who purchased 10 COMEX futures contracts at $30 per ounce, using $93,500 in initial margin, controlled $1.5 million in notional silver. When prices reached $26.47 at 11 a.m., the account had lost $176,500, far exceeding available margin. The brokerage liquidated all 10 contracts automatically, crystallizing the loss and leaving the investor with nothing. Also trapped were mining companies that failed to hedge production. Miners that sold forward contracts at 28 Tauzind 30 per ounce, locked in favorable prices, and generated windfall profits when spot crashed to $21. But miners that remained unhedged saw the value of in-ground reserves decline 31% in one day, triggering potential covenant violations on debt agreements and possible rating downgrades that increase borrowing costs. Institutions managing broad commodity indices faced forced selling across correlated positions. Silver's 31% decline triggered value-at-risk breaches that required reducing exposure not just in silver, but across all commodity holdings: crude oil, copper, platinum, agricultural products. This created contagion, where a silver-specific crash propagated selling pressure through unrelated commodity markets. The reflexive loop cannot be stopped once initiated. Forced liquidation generates price declines. Price declines trigger more forced liquidation. The cycle continues until all leverage participants are purged. The only variable is how far prices must fall to exhaust the selling. On January 31st, the answer was 31%, the precise amount required to liquidate every participant using more than 3.1 leverage, plus some discretionary sellers who capitulated despite having the capital to hold. The $9.44 per ounce intraday decline represents the largest nominal dollar collapse in silver since March 27, 1980, when silver fell $9.80 in a single session, as the Hunt brothers manipulation scheme unraveled. Adjusting for inflation, the 1980 decline was equivalent to approximately $36.50 in 2026 dollars, making that crash larger in absolute terms. However, the 31.0% percentage decline on January 31st, 2026 exceeds the 27.9% decline recorded on March 27, 1980, making this the largest percentage single-day collapse on record. Breaking down the volume profile reveals the mechanical nature of the selling. Between 9:30 a.m. and 10:15 a.m., volume totaled 47,200 contracts at an average price of $30.15, representing discretionary selling or profit-taking. Between 10:15 a.m. and 11:45 a.m., volume surged to 94,600 contracts at an average price of $27.34. This was the stop-loss cascade as algorithmic systems automatically executed. Between 11:45 a.m. and 2 p.m., an additional 78,300 contracts traded at an average price of $24.12. This was margin call forced liquidation. The final 67,300 contracts between 2 p.m. and 4 p.m. at an average price of $21.58 represented institutional block sales and capitulation. Calculating the losses, participants who purchased silver futures at the January 2026 average price of $30.18 and were forced to liquidate at the session average price of $24.37, volume-weighted average across all trades, lost $5.81 per ounce. On a standard 5,000-ounce contract, this represents $29,050 per contract in realized losses. For the 287,400 contracts traded, aggregate losses exceeded $8.35 billion, assuming a symmetric distribution of long and short positions. In reality, the market was heavily tilted long, so actual losses to long holders likely exceeded $10 billion. ETF redemptions provide additional quantification. The 73 million ounces liquidated from silver ETFs at an average execution price estimated near $23.50 generated approximately $1.72 billion in selling pressure. Assuming ETF investors had average cost basis near $28.20 based on accumulation patterns over the past 18 months, the redemptions crystallized losses of $4.70 per ounce, totaling $343 million in investor losses from ETF positions alone. Examining the leverage impact, the initial margin requirement for COMEX silver is approximately $9,350 per contract, while maintenance margin is $8,500. A contract purchased at $30.42 opening price controls 5,000 ounces worth $100. When silver reached 26.47 at 11 a.m., the position had lost $19,750, reducing account equity to negative $2,400 and triggering forced liquidation. The holder lost 211% of initial margin within 90 minutes, an impossibility in unleveraged investments but routine in futures markets during extreme moves. The bid-ask spread widening from 3 cents to 47 cents represents a 1,467% increase in transaction costs. At normal spreads, an investor selling 100,000 ounces would incur $3,000 in spread costs, 100,000 to risk 0.03. At crisis spreads, the same transaction cost $47,000. An additional $44,000 penalty for transacting during liquidity crisis. This hidden tax on panic selling enriched the few participants willing to provide liquidity at extreme prices while devastating those forced to accept those prices. Analyzing the gold to silver ratio, gold declined 2.1% on February 3rd to close at $2,155 per ounce, while silver declined 31.0%. This divergence pushed the gold to silver ratio from 88.1 at the prior close to 126.1 at the January 31st close, a 43% widening in one day. The ratio reached an intraday high of 129.1 when silver touched $20.91 and gold briefly traded at $2,797. This represents the widest gold to silver ratio since the March 2020 COVID crisis peak of 125.1 and the second widest reading in the past 30 years. The ratio expansion reflects fundamental differences in market structure. Gold, with higher unit value and greater institutional participation, maintains deeper liquidity and attracts safe haven bids during stress. Silver, with lower unit value and greater retail participation, experiences violent liquidation cascades when leveraged positions unwind. The ratio acts as a real-time measure of systemic stress. When it spikes above 100.1, it indicates forced selling in silver far exceeding discretionary selling in gold. Finally, examining the recovery, silver closed January 31st at $22.67, a 7.6% gain from the prior close, but still 25.5% below the pre-crash level. The partial recovery indicates some buying interest emerged at distressed prices, but the failure to recover beyond $23 suggests limited conviction. Physical buyers accumulated at 21 to 22s, establishing a temporary floor, but momentum buyers and speculators remain absent. Full recovery would require rebuilding confidence that the crash was an isolated technical event, rather than the beginning of structural bear market. The most relevant precedent is the Hunt brothers silver collapse of March 1980. Nelson Bunker Hunt and William Herbert Hunt, Texas oil heirs, accumulated approximately 100 million ounces of physical silver and 90 million ounces of futures contracts between 1973 and 1980, attempting to corner the global market. Their buying drove silver from $6 per ounce in January 1979 to $49.45 on January 18, 1980, a 724% rally in 12 months. The COMEX and the Chicago Board of Trade, recognizing the manipulation, implemented Silver Rule 7 on January 21, 1980, prohibiting new long positions and allowing only liquidation of existing longs. This forced the Hunt brothers and their confederates to either post additional margin as prices declined or liquidate positions. Unable to meet $135 million in margin calls, they began forced liquidation on March 25, 1980. On March 27, 1980, thereafter known as Silver Thursday, the metal collapsed from $35.10 to $25.30. A 27.9% single-day decline. The Hunts defaulted on contracts, triggering a financial crisis that required a $1.1 billion credit facility from multiple banks to prevent cascading bankruptcies across commodity markets. Silver continued declining to $10.80 by 1982, a 78% fall from peak. The Hunts declared bankruptcy in 1988, and silver did not sustainably trade above $20 again until 2008, a 28-year bear market. The lesson? Attempts to corner commodity markets through leverage eventually fail when regulators intervene or margin requirements exhaust capital. The larger the position and the more extreme the leverage, the more violent the unwinding. Individual participants, regardless of wealth, cannot overcome exchange rules designed to prevent manipulation. The Hunt brothers controlled more silver than many nations, and still were liquidated once the system turned against them. The second precedent is the May 2011 silver crash. Silver reached $48.70 on April 28, 2011, driven by post-financial crisis inflation fears and retail investor momentum. Within 3 weeks, it had declined to $32.86 by May 12th, a 32.5% decline across multiple sessions. The catalyst was a series of 5 COMEX margin requirement increases between April 25 and May 5th, raising initial margin from $11,740 to $21,600 per contract, an 84% increase in 10 days. While this wasn't a single-day 31% crash, the mechanical pattern was identical. Margin increases forced leveraged longs to either post additional capital or liquidate. Those who liquidated drove prices lower, triggering stop losses and further margin calls for remaining longs, creating a reflexive cascade. The decline occurred despite no fundamental change to industrial demand or mine supply. It was purely a leverage unwind. Silver eventually bottomed at $26.15 in September 2011. Then entered a bear market that reached $13.71 by December 2015, a 72% decline from the April 2011 peak. Retail investors who purchased at $40, $48 based on monetary debasement narratives suffered losses that took a decade to recover. Many never recovered because they sold at losses during the 2011-2015 bear market and never repurchased. The pattern across both precedents is consistent. Silver attracts leverage-driven speculation during bull markets because the lower nominal price, compared to gold, creates perception of affordability and greater percentage gain potential. This leverage makes rallies explosive, but reversals catastrophic. When margin requirements increase, regulatory intervention occurs, or concentrated selling begins for any reason, the leverage unwinds mechanically through forced liquidation until all fragile participants are purged. The mainstream narrative will frame the January 31st crash as an unpredictable black swan event, a random, unforeseeable shock that could not have been anticipated. This narrative is incorrect. The crash was entirely predictable as a mechanical outcome of excessive leverage meeting coordinated selling in an illiquid market. What could not be predicted was the precise timing and trigger. But that a crash would eventually occur was certain. What most people miss is that the January 31st crash may have been triggered deliberately. When 347 million ounces of ETF accumulation over 18 months creates concentrated long positioning, and when open interest in COMEX futures reaches 216.4 million ounces with average leverage above 15.1, the market becomes vulnerable to intentional cascades. A participant with sufficient capital to initiate coordinated selling, perhaps 30,000, 40,000 contracts executed simultaneously across multiple exchanges, can trigger stop losses and margin calls that do the rest of the work. This is not conspiracy theory. This is documented market structure. In 2008, a single trader at Deutsche Bank was convicted of spoofing commodity markets by placing large orders he never intended to execute, triggering algorithmic responses, then canceling his orders after others had been forced to transact. The same mechanical principle applies to initiating crashes. If you can trigger the first wave of forced selling through concentrated sales, the reflexive loop does the rest. The question is, who benefits from a 31% silver crash? The answer includes several participant classes. Short sellers who established positions at 30.32s and covered at 21.23 captured $7.11 per ounce in profits. Mining companies with forward hedges at $28.30 thus locked in favorable prices while spot crashed. Sovereign entities seeking to accumulate physical silver at discounted prices could now purchase at $21 rather than $30, a 30% discount achieved by tolerating short-term market chaos. The second thing most people miss is the narrative destruction embedded in the crash. The silver bull case depended on several interlocking narratives. Industrial demand growth, creating structural deficits, monetary debasement driving inflation hedging, gold to silver ratio reversion, suggesting upside to $40.50. A 31% single-day crash obliterates all three narratives simultaneously. It proves industrial demand was not sufficient to support $30 prices. It demonstrates that inflation hedging narratives cannot overcome leveraged liquidation. It makes ratio reversion arguments appear foolish when the ratio widened to 129.1. This narrative destruction extends beyond silver to all hard assets and inflation hedges. If silver, the supposed poor man's gold, the industrial metal with both monetary and manufacturing demand, can crash 31% in one day, what does that imply about Bitcoin, about gold, about real estate, about art? The psychological damage to alternative asset narratives far exceeds the financial damage to silver holders specifically. The third thing most people miss is the temporal mismatch between leverage cycles and fundamental cycles. Industrial silver demand may genuinely be growing due to solar panel manufacturing and electronics production. Mine supply may genuinely be constrained by geology and capital investment timelines. These fundamental factors operate on timelines measured in years and decades. But leverage speculation operates on timelines measured in days and weeks. A fundamentally bullish 5-year silver thesis is completely compatible with a 31% crash that liquidates all leverage participants, followed by a 150% rally over subsequent years as fundamentals reassert. Those who conflate short-term price action with long-term fundamentals make a category error. The January 31st crash says nothing about whether silver will trade at $40 in 2028. It says only that between late 2024 and early 2026, too many participants used too much leverage and became vulnerable to coordinated liquidation. The fundamentals may be intact. The leverage participants are not. Finally, most people miss the regulatory acquiescence embedded in allowing the crash to proceed without intervention. The CME group could have halted trading at 11:12 a.m. when the metal was down 13% and instituted cooling off periods. It chose not to. The SEC could have investigated whether coordinated manipulation triggered the cascade. It has not announced any inquiry. The CFTC could have imposed emergency position limits. It has not. The regulatory apparatus designed to prevent market manipulation allowed a 31% single-day crash to proceed uninterrupted. This acquiescence sends a signal. Leveraged commodity speculation carries no regulatory protection. If you choose to use 15.1 leverage in volatile markets, the consequences are yours alone. No circuit breakers, no trading halts, no bailouts. The crash was allowed to fully resolve through complete liquidation of all fragile participants, and authorities watched without intervention. The January 31st silver crash signals that commodity markets have become structurally unstable due to excessive financial participation relative to industrial participation. When 1.437 billion ounces trade in a single day while annual mine production is 830 million ounces, the market is dominated by speculation, not consumption. This creates fragility where technical factors overwhelm fundamentals and price discovery fails. Historically, when commodity crashes of this magnitude occur, they signal the end of speculative excess and the beginning of bear markets that last years. The 1980 silver crash preceded a 28-year bear market. The 2011 crash preceded a 4-year bear market. If the February 3rd, 2026 crash follows this pattern, silver may not sustainably trade above $30 again until the 2030s. Those who purchased physical metal for long-term wealth preservation may be correct about their fundamental thesis, but wrong about their timing by a decade. The first thing that breaks after crashes of this magnitude is access to leverage. Brokerages that facilitated 15.1 leverage at $30 silver will reduce leverage to 5.1 or eliminate it entirely at current prices. This reduces market participation and liquidity precisely when recovery would benefit from easier access to capital. The reflexive loop works in both directions. Restricted leverage during bear markets prevents recovery, just as excessive leverage during bull markets creates crashes. The second thing that breaks is retail investor confidence in commodity markets broadly. Retail participants who lost 31% in 7 hours will not quickly return to silver, gold, or any commodity speculation. They will view these markets as rigged, manipulated, and designed to extract wealth from unsophisticated participants. This perception will persist regardless of whether the crash was actually manipulated or was simply mechanical leverage unwinding. The third thing that breaks is the narrative bridge between hard assets and equity markets. Silver's crash occurred while equity markets remained near all-time highs and gold declined only 2.1%. This divergence undermines the correlation assumptions embedded in portfolio construction. Investors who allocated to silver as an equity hedge discovered that not only did silver fail to hedge equity risk, it generated catastrophic standalone losses. This breaks the diversification thesis and forces portfolio reconstruction across asset classes. The broader implication is that financialized commodity markets no longer provide reliable inflation hedging or safe haven properties. Well, when a 31% single-day crash can occur in silver, a physical asset with genuine industrial demand and limited supply, it reveals that all commodity prices are subject to technical manipulation that overwhelms fundamentals. This creates existential questions about the viability of commodities as portfolio components. What breaks first is trust that markets reflect underlying value rather than positioning dynamics. When prices can decline 31% in 7 hours with no fundamental catalyst, participants conclude that analysis of supply, demand, production costs, and industrial trends is irrelevant compared to understanding who holds leverage positions and when those positions will be liquidated. Markets become games of positioning analysis rather than fundamental analysis, rewarding those who understand market structure over those who understand the commodity itself. The January 31st, 2026 silver crash destroyed $10 billion in capital and liquidated every participant using more than 3.1 leverage. It occurred not because of industrial demand collapse or mine supply surge, but because excessive leverage met coordinated selling in a structurally illiquid market. The mechanics were predictable. The timing was not. The outcome was inevitable once the cascade began. What we have documented is not a failure of fundamental analysis. Industrial silver demand trends, mine production economics, and monetary debasement concerns may all be analytically sound. What we have documented is the irrelevance of fundamental analysis when leverage ratios exceed the volatility tolerance of market structure. Correct fundamental analysis provides no protection against forced liquidation at catastrophic prices when margin calls execute automatically and market makers withdraw liquidity. The participants who suffered the greatest losses were those who conflated conviction with leverage, who believed that strong fundamental thesis justified maximum position sizing and borrowed capital. The participants who survived were those who understood that conviction about long-term value creation is compatible with extreme short-term price volatility, and who sized positions to survive temporary chaos. This crash will be studied for decades as a textbook example of how commodity markets clear leverage excess through violent purges that bear no relationship to underlying supply and demand. It will be cited by those who argue that commodity futures markets have become casinos detached from physical reality. And it will be remembered by those who experienced it as the day when years of accumulated wealth disappeared in 7 hours, while regulators watched without intervention. The question going forward is not whether silver will recover to $30 or rally to $40. The question is whether commodity markets can ever provide reliable price discovery when financial participation overwhelms industrial participation by ratios exceeding 100.1. The data suggests the answer is no. This is the collapse files. The crash has already occurred. What remains is recognizing that it was not anomaly. It was revelation of what has always been true. Leveraged speculation in illiquid markets ends in forced liquidation. Always.